Yo, what's going on, guys? Bexio, and today we had a brand new video. This time on Disney stock, because it's just been beaten and battered down really bad in the last couple of months, even. And we've seen a lot of reasons for why that might be the case. But I think that Disney could be a massive play coming up in the near-term future. But before we jump into that, if you guys are not subscribed, make sure to smash that sub button because we are on the road to 1,000 subscribers. But let's jump right into this Disney stuff. So we can look at Disney's chart here and see that the biggest kind of resistance and level it traded at was around this 178. You see it kind of went above it for a bit and then fought it for a long time. And we see just kind of this last one, just rejection and complete tumble down. They had not a great earnings call compared to their last ones and a lot of things like that. But I think the market overall isn't really pricing Disney Plus how it should be. And Disney Plus is offering just a lot of things that Disney, can compete with like Netflix on. And we look at Disney's market cap right now, which is $267 billion. We compare that to Netflix and look at Netflix, they're 274 billion. So they're way more, but they are just that streaming service. And Disney has that streaming service on top of their parks and recreation stuff, which has been the suffering part and the weary part for investors and everybody, because obviously everything going on, they haven't really been able to utilize their parks how they would have liked to. And that can cost them money and isn't the best thing for them to actually go on with. So it's something that investors are very worried about. But the streaming part of it and them competing with Netflix on streaming is massively undervalued, I think. We can see that right here, talking about in their last earnings call, they slowed down on adding subscribers, so that was a miss. That was something that sent them tumbling to start. And they just got 2.1 million subscriber growth for the quarter, which was a miss on what Wall Street had expected. You can see right here, as of October 2nd, Disney Plus has 118 million paid subscribers worldwide, which is massive. And if you compare that down here, just compares it directly to Netflix. I mean, it's the #2 streaming service for paid subs. Nothing even comes close, even trying to compete with Disney or Netflix. And obviously, Disney's includes right here their total subscribers is 179 million. So of the 179, 118 are from Disney Plus, their newer service, and 179 total because they have Disney Plus, ESPN Plus, and Hulu. So they have a lot of streaming services, but it comes very close to competing with Netflix. And like we saw before, Netflix's market cap is bigger than Disney's, but they're only streaming software kind of company, whereas Disney has that component to them, but they also have the parks and everything that generate money for them as well as their IP. Disney just has massive fan base that will go and watch Disney stuff no matter what, just because they love it that much. So Netflix kind of has that, but not really. People watch Netflix originals, they like it, and it's good stuff, but I don't think there's anyone who's like a diehard Netflix person, but there are diehard Disney people. And you can see during their earnings report, they even said right here that they said, we continue to manage our direct-to-consumer business for the long term and are confident that our high-quality entertainment expansion into additional markets worldwide will enable us to further grow our streaming platforms globally. Completely agree with that. Disney is a global brand. They have parks globally. Disney's just known all over the place. The streaming service gives them extreme leverage. Also brings them a lot more margin. So the money they can make off of these streaming services is way more margin than what they would make in like the parks and stuff, just because the parks have so much upkeep costs. They have to pay people to work there, doing all these different costs to it. Whereas Disney Plus, you run the streaming service and there you go, good to go. Obviously, you pay for the production of stuff and like movies and shows to go on, but at the end of the day, it's a lot more money coming into Disney's pockets as margin instead of expenses. And you can see just some of their gains. Total Disney revenue up 26%, $18.5 billion which is up from their prior year period. Kind of expected. Last year was not good for Disney at all. The parks were basically closed the entire time with no option of making money, but now they at least have some sort of way to get them running. And they reported 290 million or 37 cents per share compared to what it was a loss of 580 million just a year ago. So those are obviously growing numbers, good numbers for a nice little rebound there. Disney is much more of a rebound play, kind of a recovery play, because a lot of people put a lot of value onto the Disney theme parks themselves. And I think people are discounting Disney Plus and their streaming services that they have and how much money that can actually generate for them. So these numbers we're seeing now are kind of being held up by the streaming services as compared to the parks, which usually are the cash cow for Disney, bringing all of the money for them. But it's not happening right now. So I think once the parks start to get to really reopen, fully be open, and they start bringing all the money, the streaming service bringing all the money, we're just gonna see Disney revenue just explode, and that might take a little bit. Obviously, the new Omicron variant, all of that stuff going on, it's just throws a wrench into Disney and any recovery play. They're all going to go down on this news, and we're seeing that happen with Disney right now. But even these gains and stuff are up for the year. They're good numbers they're reporting. They were not what Wall Street was projecting, so they miss a little bit there. That causes obviously the stock to move down. But we can also look at what analysts are saying and insiders, hedge funds, all of those guys, what they're doing. So obviously we have moderate buy for Disney with 0 sells being said by analysts. So we're seeing obviously people a lot more bullish on Disney. In the 12-month price targets, we see the high 263, the average 204, and even the low 172 is over where the Disney price is right now. So looking like we could have a little bit of a recovery, a little bit of a jump up in Disney is what's kind of expected over the next 12-month period from analysts. Now, analysts can be wrong and stuff, and they are wrong a lot. So, just basing on them, not really the smartest thing to do. But looking at Disney's numbers, their revenue jumping year over year. This next year, if they can have more revenue come in again, grow those subscribers for their streaming platform, that's going to be massive. Because I think the streaming service, Disney Plus, even ESPN Plus, Hulu, all those things that Disney has, the market is underpricing them or just kind of ignoring them because of the parks and the risk of the parks not really running full time for the near term future, which has been a massive thing for Disney in terms of money and revenue. But if we look at the insiders as well, we can see obviously recently the stock kind of where it was kind of trading sideways, and we see this fall here. There's a lot more buying than selling going on compared to before in the year when Disney was riding up to these levels. A lot more selling compared to buying, although not terribly a lot more. This was the only super outlier, and then the buying kind of took over, and we see 3 sales. This is 1 sale, and then 10 buys, 10 buys. This is 8 buys. So obviously a lot of buying from insiders. They know or think that they know where these streaming services are going, where the park can be going, new revenue avenues for them to get. And Disney's in a great spot to just capitalize on all this stuff. And they have a massive brand. It's known globally. That's why Disney Plus has done so well. A year and a half into them launching it, over 100 million subscribers. It didn't take a lot for them to get there. And even looking at the hedge funds, obviously, they increased their holdings by almost 250,000 shares. And they've just kind of been consistent here. This drop down in price, obviously hedge funds kind of selling, but after this drop down, they've just been buying tons and then kind of leveling out here for this recent kind of where it was basically trading very sideways, Disney, for a long time. And we see this recent drop down, and there's a lot of reasons for that. Obviously, the miss in earnings a bit caused that. The variant caused that. But another thing that massively caused it was this thing called tax loss harvesting. So for the last year, Disney is actually down in price, which means a lot of these hedge funds or individuals or anyone in it can actually take a tax loss on it. So they're going to sell securities at a loss to offset the capital gains tax liability. So this strategy is typically employed to limit recognition of short-term gains. So basically, what tax loss harvesting is if they have, say they have Disney and it's down on the year, they can sell it and then they would have to wait 30 days to buy it back, and then lock in those losses, and then they can take those losses and offset some gains that they had during the same year, so they pay less taxes. So with Disney's chart looking like this for the daily here, and even if we go kind of monthly, this is basically the year right here. So obviously 1, 2, 3, 4, 5, 6, 7, 8, 10, 11, 12. So this candlestick was around Disney. Even if you go to the lowest point, 161, we are still below that. So hedge funds, large players and investors, yeah, anyone really is selling right now. And that's where we saw this massive volume down, was on earnings, tax loss harvesting, the variant news, all this stuff hit all at once, obviously plummeting. And we're probably going to have to wait 30 days next month, the beginning of the year, where we'll see even Disney try and make a comeback or a rally. You see it doing a little bit right now, up like 3% today, but nothing crazy. But that's a lot of the reasons why Disney is suffering right now. There's tax loss harvesting, the variant that scares people away. Obviously, the park things are big things for Disney. And with people being scared if they're going to be shut down, then they're going to sell the stock. So you have that. You have all of these different things, and a slight miss on earnings doesn't actually help. So I think Disney could be a pretty good play for the near-term future. I think they're going to get parked up and running relatively soon, and even if they don't, the streaming services that they have are just massively slept on. They have so much potential to actually explode. So we'll see where it goes. But that's going to do it for this video, guys. As always, don't forget to smash that like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next